Hi everyone, and welcome back to Living in Suffolk County, New York, where we talk about all kinds of things related to home shopping in Suffolk County and beyond. I'm Mary Calamia, licensed real estate salesperson with North Shore Properties Realty, and today I'm kicking off my Homebuying 101 series, and in this first episode we'll be diving into step 1, getting your finances in order. I know it sounds so basic, but if you're looking to finance a new home, understanding your financial situation can save you a lot of time and heartache. Stay with me to the end because I have an important tip for first-time home buyers. So let's get started. The first thing you need to do is know your credit score. Your credit score plays a significant role in determining the interest rates that you'll qualify for when applying for a home loan. You need a credit score of at least 580 to qualify for an FHA loan or a VA loan. You can qualify for a conventional loan with a score of 620, but a score of 720 is going to give you the most options. We'll talk a little bit more about the difference between these types of loans when we talk about financing in future videos. In the meantime, check your credit reports. See if there are any resolvable issues that are negatively affecting your scores and resolve them if you can. You can obtain a free copy of your credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once a year. Check for any errors and address them promptly to ensure an accurate reflection of your creditworthiness. Once you have a clear picture of your credit health, it's time to assess your overall financial situation. Take a close look at your income, expenses, and existing debts. Lenders will look at what's called your debt-to-income ratio. This tells them how much your income will be going to pay off other debts and allows them to estimate how much you will have left to make a mortgage payment each month. Consider your monthly budget and identify areas where you can save or cut back. This is going to give you a much better understanding of how much you can afford to spend on a home. Also, consider any debts you can reduce or eliminate so you can increase your borrowing power. Now that you have a handle on your finances, it's time to determine your budget for buying a home. As a general rule, you should aim to keep your mortgage payment below 28% of your gross monthly income. And you should factor in other home ownership costs like property taxes, interest, and maintenance. Creating a realistic budget will help you to determine where you can look for homes and help you avoid falling in love with properties that are outside your comfort zone financially. If you need help, you can also use a home affordability calculator to help you figure out exactly what you can afford. I'm going to take you over to my computer and we're going to take a look at one of those calculators now so I can show you exactly how that works. So here I did a simple Google search for home affordability calculator, and you can see a bunch of them come up. They're on so many different websites, all these home affordability calculators. Feel free to use any one of these. In fact, I would recommend that you use more than one so you can compare the numbers because they may vary. And I opened up one just to give you an idea of what it looks like. So you're going to put in here your annual gross income. There's a sample one already in here. Monthly debt, this here is your other loans. So you might have a car payment or a student loan payment or some other monthly debt. That doesn't mean your regular household expenses. Okay, that's actual other loans. How much are you putting down on the home? The interest rate, which they have in at 6.82, it's probably prevailing rate today. And then you can also adjust the property taxes, homeowners insurance, and here they even have a spot if there are HOA fees, if you're moving into an HOA. And it will tell you this is what we talked about earlier, this 28% of your monthly gross. This will tell you what you can afford in terms of a house price and estimated closing costs and what your monthly payment would look like. This here, this max purchase budget, is if you're going to stretch it as far as a lender would allow. This is how much you could afford to how price offer on a home and your monthly payment, what your monthly payment look like, and your estimated closing costs. And you could play around with these numbers and you could change all of the factors. So let's say we want to say we have an adjusted annual gross income of, let's say, $90,000. And no monthly debt. You have no other loans. You're only putting $15,000 down on your home. You have HOA fees of $100 a month. I'm just messing with the numbers. And it will tell you, you see how it changed the price of the home that you can afford, what the monthly payment would look like, and your estimated closing costs. And here at the very, very high end, again, is if you really, really want to stretch it, this is what they're saying you can afford. So just wanted to give you an idea of how these home affordability calculators work. You can mess around with them, change the numbers. If you're not putting 20% down, then you are going to have PMI. Let's say that's 150. Again, I'm making up numbers. And you see it will change those numbers and drop down what you can afford to purchase. If your income goes up, once again, these numbers change in reflecting what is on this side of the calculator. So there you have it. Use this tool because it will tell you exactly what you can afford. One of the most significant financial aspects of buying a home is saving for a down payment. The common belief is that you need a down payment of at least 20% of the home's purchase price, but that really isn't true. You can purchase a home with as little as 3% down and even 0% down if you qualify for a VA loan. A larger down payment is preferable so you can avoid having to pay PMI or private mortgage insurance. You will also need to have money available to cover your closing costs. There are a lot of things that determine what your closing costs will be, but it's fair to say they'll usually be between about 3 and 6% of the loan amount. Your lender will provide you with a disclosure form detailing all of the closing costs you can expect to pay. I jumped back onto my computer for a minute because I just wanted to show you what a closing disclosure form looks like so that you're not unfamiliar with it when you see one for the first time. It details all of the information about the loan itself, how much you're borrowing, the interest rate, and boy, doesn't that interest rate look yummy right now. And so at this part of the form, it shows you what to expect over the life of the loan, and then your costs at closing. The closing costs, the estimated cash that you need at closing, and all of the details, all of the fees and the prepaids and everything else involved in the closing of your loan. So you would get something like this from your lender, and I know it's a lot of information on it, but you would certainly ask your lender to explain it and go over everything with you thoroughly. It tells you a whole lot of information. Anyway, I'm going to bounce off of the computer now and get back to closing up the video with the last segment that I promised you. And I told you if you stayed with me to the end, I would have some important tips for first-time home buyers. So here we go. Check to find out what first-time homebuyer programs are available in your state before you start looking for a home. These programs can make a significant difference in your ability to finance your first home, but there's usually a lengthy application process, and some programs even require you to sit through some classes. So it's worth looking into them a few months before you even begin shopping. These programs provide first-time homebuyers with grants or low-interest loans to cover some or even all of your down payment and closing costs. They vary from state to state and come in different forms like low-interest loans, deferred payment loans, and even forgivable loans or grants that don't need to be repaid, providing you remain in the home for a certain number of years and you stay current with your mortgage payments. These programs all vary in size and availability depending on where you live, and they have income and credit score requirements. So do your homework so you know what's available before you start looking. I can't tell you how many first-time home buyers lose out on these programs because they found the home of their dreams, but they didn't do any of the steps to apply for any of these programs and they missed out. So do your homework. So that's it. Step 1 in the home buying process, getting your finances in order. Knowing your credit score, assessing your financial situation, determining your budget, and saving for a down payment are really important steps to paving the way for a successful home purchase. I love what I do, and I love helping buyers find just the right home, and they fall in love with it, and then we find out that they didn't do their financial homework, and they just can't afford that home that they just fell in love with. So do your homework, know in advance so that you can save some heartache down the road. If you need help with this or any of the other steps in the home buying process, call me or text me at 631-835-1824, or you can email me at livinginsuffolkcountiny@gmail.com. If you found this information helpful, be sure to give it a thumbs up, and don't forget to subscribe for more home buying tips. In the next episode, we'll be discussing Step 2, mortgage pre-approval. Until then, happy home hunting.